Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. Click on your video settings, go into playback speed, set that to 1.25 to get through this video much faster. I actually recorded an hour-long video, a very detailed video, and just as I was about to start editing that video, I found out that there was no audio. There was no audio. I wasted an hour. So please, guys, show some love, some sympathy likes. I would really appreciate it. I don't make any money off these videos, guys. If you see ads on the videos, all of that money actually goes to YouTube. This is not a monetized channel. It's completely free. I do this completely free. If you want to support the channel and you want to get access to all of my trades, my trade ideas, investments, my portfolio, etc., you can do so by checking out the link in the description and joining our private Discord community. It's $20 a month. If you want to support me, you can do that. We're seeing people share ideas, trade ideas, strategies, data, statistics, interpretations of different economic data. The community has been growing, so thank you so much to all of you legends for supporting this channel. Now let's get right into the video. So the stock market closed down 0.7% on the S&P, down 1.25% on the NASDAQ, and down 0.5% on the Dow. Let's take a look at the different sectors, guys. Leading was energy, up 0.66, followed by utilities and defensive. Look at this, guys. The leading sectors are the defensive sectors: energy, utilities, and consumer defensive. Everything else is somewhere in the middle, and then we have communication services, materials, and cyclicals lagging. The risk on sectors, communication services, cyclicals, and technology are considered the riskiest sectors in the market, and they usually lead the market in bullish uptrends and lag the market in downtrends. We're seeing a clear defensive rotation into energy, utilities, and consumer defensive. You really don't want to see a rotation into energy after the FOMC minutes came out yesterday, because that would indicate that market participants believe that the Fed will fail in controlling inflation and that inflation will continue to run hot. That's not what you want to happen for this recovery to be sustainable. Let's take a look at the stock market map really quickly. Again, we're seeing defensives like Walmart and Costco in the green, energy in the green. We're seeing Eli Lilly, one of the most defensive plays in the healthcare sector, right? We're seeing insurance in the green, and we're seeing Apple and IBM, really the only green large caps in the tech sector, and they're the most defensive names out of everything. The most offensive, the most risky sector in the technology group, and the best performing going back 6-7 years is semiconductors, and they're lagging by quite a lot. Nvidia is down 2.8%. AMD is down nearly 2%. That's not what you want to see in a recovery. You want to see semiconductors leading, not lagging. So again, all of these are warning signs. Let's take a look at the daily chart of the S&P 500. We have our descending 200 daily moving average. We rejected off of that a couple of days ago. We failed to touch that again today. We had a brief rally right here that managed to fill the gap that we had. We gapped down in the morning. We rallied after the FOMC minutes came out and then completely sold off. So this is a bearish development. Taking a look at the 2-hour chart here, guys, we're absolutely hugging the 20 period moving average on the 2-hour chart. We're sitting below the 9 period moving average. As long as this continues, we'll start seeing the 20 period flatten, perhaps start to turn down. And if we see a break below a retest and that retest fails, that will trigger a significant sell-off in the market. And we are seeing warning signs that this rally is probably done. It has probably topped, and this is why. Let's take a look at the HYG, the junk bonds, the risky bonds. When bond traders believe that the recovery is strong, they pile into this one, and when they start to be bearish and believe that the market will turn down, they start to dump these high-risk bonds. And here's what happened, guys. We had significant divergence between the junk bonds and the S&P 500, and the way these divergences play out is when you start to see a divergence at the top of a trend or at the bottom of a trend, that indicates a trend reversal. When you see it at the bottom, it indicates a reversal to the upside. When you see it at the top, it indicates a reversal to the downside. And here's what happened, guys. We had a very obvious divergence. Take a look at this. August the 11th, we had the top. we've been making lower highs, and we've now significantly broken down. We did not manage to fill the gap like we did on the S&P 500. This is a very significant development. Let's take a look at the S&P 500 from August 11th to August 16th, and here it is, guys. This is what it looks like. Look at that. We've been making higher highs as the HYG has been making lower highs. The exact same thing happened right here in late May before we got that massive sell-off. Look at this. We topped on the 27th and we started to roll over on the S&P 500, guys. Take a look at this. This is May the 27th. We moved sideways. We moved sideways for a long time. So this is divergence. We moved sideways. We actually made a slightly higher high right here on June 2nd. On the HYG, we failed to make a higher high, right? And this divergence again warned us that a sell-off is coming. The exact same thing happened right here. April 13th to April 21st. Let's take a look at the S&P 500. April 13th, April 12th even to April 21st. We had a higher high. Right here we had a lower high, and that led again to a significant sell-off, a 13% sell-off on the S&P. We had another divergence right here, guys, in February the 2nd to February the 9th. Let's take a look at the S&P 500, February the 2nd to February the 9th. We actually made a slightly higher high, basically flat, while the HYG made significantly lower highs. So we had a divergence right here, we sold off, a divergence right here, we sold off significantly, another one right here, and we sold off significantly, and we're now seeing a divergence right here, preparing us for a significant sell-off. It will come in phases. The first phase, I expect us to fill this gap right here, so go down to $410. The second sell-off, I do not expect the market to actually just sit around here. I expect a significantly larger sell-off. The second sell-off will probably take us down to this important key pivot point. Look at this pivot point, guys. Support, broke through, resistance, broke through, retested, had a massive rally. So this is an absolutely key level. This $390 level is a key level. And in fact, guys, if you take a look at my video where I talk about bottoming indicators, please check that video out. If you haven't already, I talk about a lot of statistics that go back to 2000 and some statistics that go back to 1950. Basically, guys, there's a 97% chance that this low will hold, and that is because we recovered more than half of that sell-off. Okay, so we recovered the 50% retracement level and closed above that. When that happens in bear markets, it often means going back to 1950. It always meant going back to 1950 that this low will hold. We will not break this low. Prior to 1950, we had 50% retracements that broke the low, but after 1950, that never happened. Okay, so there's a 97% chance that this low will hold. There's a 3% chance that this low will be broken. Okay, so we established that this low will probably hold. So where do we go from here? Well, there's at least a 50% chance that the next sell-off will be at least 10%. Okay, going back to 2002, we took a look at a lot of studies, 61 different indicators, 12 different studies. Again, please guys, check that video out if you haven't already. And what we found out, guys, is that in bear markets, when key breadth indicator levels in the NASDAQ and the S&P 500, when they hit key levels, it usually indicates that the bear market is over, but a significant retest is likely. And that retest ranges from 10% to 15%. The worst case that we found out was 15%. So 10%, 10 to 15% in bear markets. And bull markets, where we don't get a decline that is greater than 20%. Remember, guys, this was a greater than 20% decline. It was 23.5. So this is a bear market. But in bull markets, the sell-off usually, the average is about 6 to 5%, 5 to 6%. But in bear markets, it ranges from 10 to 15%. Okay, so let's assume that we've topped right here at $431.50. Let's assume that. So if we go down 9%, look at that, guys. We retest the significant pivot zone. So this is very likely. It's highly likely in my opinion. And if we go down 12%, 12.5%, we fill this key gap right here. So again, my first level to look at before I start to really load up on shares, on options, switching from being neutral to slightly bearish to being completely bullish. I would start to accumulate shares when the S&P 500 hits this key level. So I'll be watching the S&P 500 to start to pivot to being bullish on all of the companies that I like, including AMD, Nvidia, Microsoft, Google, Amazon, and potentially some other cryptocurrency stocks. Okay, the second zone again is 378. So the scenario in my head that makes sense to me, okay, this is just a scenario that makes sense to me. We see something like this. We see a sell-off into September. We bounce off the $390 level. We go back up. We get rejected at $400. We break below, right? We go down to 378, and then we bounce back. And this false break right here creates a false break bottom. Okay, that's one scenario, that's one likely scenario that makes sense to me. I expect that we will see significant buying pressure at 390. So it will take a lot of volatility, a surprise, perhaps something geopolitical, a war with Taiwan or something like that, something significant to push the price down. And I think that a lot of buyers will step in, and that will push the stock market up. Even more so if we see a divergence on the S&P 500 and the PPO. If, for example, this low creates something like this, a higher low on the PPO, and then we see a lower low on the S&P, again, that would be an amazing opportunity to get in and a beautiful reversal signal. Alrighty, so let's move on to the triple Qs. The triple Qs, we've seen a very clean rejection of this significant resistance line. Look at this resistance line. We rejected once. We had a false break after that, and then after that false break, we had the beginning of the bear market. We had a second rejection in this bear market rally, and we're now seeing another rejection right here. So as long as this rejection holds, I do suspect that the market will continue to sell off. I think the Qs will be stronger than the S&P 500. I think tech will do a little bit better than the rest of the market, especially defensive big cap names like Google and Microsoft. Now let's take a look at the small caps, the IWM, the Russell 2000. Again, we've seen a beautiful rejection right here of the 200 daily moving average, and we're now seeing a red candle. We had an indecision candle above the 200 daily, and we're now seeing a red indecision candle. If you take a look at the S&P 500, we had a green rejection candle. Okay, this candle is bearish, but not as bearish as the IWM. Why? Because the IWM opened at 198.68. It rallied slightly to the upside, got rejected again at the 200 daily, and then it closed below the open. This is significantly more bearish than attempting a rally, failing, and then closing above the open, right? And it's quite often, guys, to see these small caps begin to sell off before the rest of the market. And it's also quite often to see the small caps begin to bottom, to base before the rest of the market. So the small caps tend to be somewhat of a leading indicator into what is happening in the market. With that being said, we're still in a strictly bullish context, right? We are now making higher highs, higher lows. We haven't managed to take out the 9 EMA, daily moving average. We haven't seen a bearish crossover just yet on the momentum, but this looks to me like possibly a topping process where we try to retest again, fail, and then start to sell off. Oh, guys, and I forgot to mention the counts. The counts on the trend for the S&P 500. We have a 1, 2, 3, 4, 5, 6 count right here. And if you guys follow Elliott wave theory and trend counts, usually a trend reversal occurs at the 9 or the 12 counts. So assuming that this trend will come to an end, we need to see a 9 count candle that is red, okay? That signals the beginning of a new downtrend. So we have Thursday, Friday, 7 and 8, and then 9 on the Monday. We should see a nice red candle on the Monday, and that would indicate the beginning of a new downtrend. Let's take a look at the VIX, guys. The VIX has been downtrending for 8 straight weeks. This is the first week so far that has been trending slightly above the previous week. If we close above 19.5 on the VIX, this would be the first reversal in the VIX for 8 weeks. 8 down weeks on the VIX is extremely rare. It is extremely rare. So this was expected, especially with the FOMC minutes coming out. And still, guys, remember, next week we have the Jackson Hole meeting at the end of the week, the Jackson Hole Symposium, where we should expect a lot of Fed speakers to come out and say a lot of things that will drive the market down. I suspect that Jay Powell will come on next week, Friday, Saturday, and talk the market down. I absolutely expect that will happen. It is not in the Fed's interest to see the market move up as inflation is hot. You want to see the market move down for the wealth effect to take place. I talked about the wealth effect in the previous video. Please check it out if you're not familiar with the wealth effect. It basically talks about how people reduce their spending when the value of their assets go down, when the value of your home, when the value of your 401k, your investments go down. We tend to spend less. Everything that the Fed has been doing, driving interest rates up, has been to influence our spending, to reduce our spending, to bring inflation down. Now let's quickly take a look at the 10-year yield. The 10-year yield has been creeping up since the 1st of August. So this has been warning us, right, that this rally will significantly slow down and perhaps come to an end. I still suspect that we will see a head and shoulders formation, a rejection of this 50 period daily moving average right here at around 2.962%. Maybe we overshoot a bit and reject at 3%. We will see if that happens. Again, guys, we all want to see the 10-year yield move down because it trends with inflation. It actually tends to trade ahead of inflation. So if you start seeing the 10-year yield move up, it means that market participants, bond traders are expecting that inflation will actually move up for the month of August, okay? And this has been the clear signal since the 1st of August. We've been trending up. So I do suspect that the next inflation reading might surprise to the upside. We will see. Taking a look at the 2-hour chart, the 2-hour chart moves with the federal funds rate. So this is a significantly faster moving instrument. And we've been flagging, we've been forming a bull flag. We've rejected now once. Now, if we do break above 3.35% right here, 3.335%, and we stay there, okay? If we stay there, not just break, reject, and come back down. If we stay there, that will be a warning shot again that the stock market rally will probably come to an end. This is the dollar index, guys. We have a clear bullish crossover right here. We've been trending up. This looks to me now like a false break, and we might start to trend back up again. Watch for a break above 107. If we break above 107 and stay there for a couple of days, that will be a surefire sign that the dollar will start to rally again and for the market to start to sell off significantly again. So keep an eye out on the dollar index. Let's take a look at Apple. Apple has been going absolutely bananas. Okay, it went up, let's see, 35%. Absolutely insane. This is one of the craziest rallies that I've seen in any big cap tech company. And this is not the first time. This is not the first time we've seen Apple do something like this. The exact same thing happened in 2008. Look at this, guys. We had this massive sell-off, 40% sell-off. And then off the lows, we had this insane 60% rally, right? Nearly coming back and retesting the highs. It came really close to retesting the highs. Eventually, this rally moved sideways for a long time, losing steam. And eventually, selling off by 50% in a matter of a month and a week. In a matter of 5 weeks, we sold off 50% on Apple. This tends to happen with Apple. This is very common with Apple. Apple tends to significantly outperform for months and months and months in a bear market. And just at the end, just near the end, just before that massive sell-off in the stock market, Apple finally gives up. Investors in Apple finally give up and they sell, and usually it produces a violent sell-off. Now, I'm not predicting that we will see a violent sell-off in Apple. I do not know. It's impossible to know. But I do have a few targets, very obvious and clear targets. We have the first target right here at $155 to fill this gap. This acted as a significant level of support. Once broken through, acted as significant level of resistance, and once broken through again, it will act as support. I suspect 155 to 150. The second target, we might see Apple go all the way down to retest this trend line right here. Why? Because whenever the stock traded above this trend line, it represented bullishness in the market, right? This whole phase was extremely bullish, and anytime we traded below this trend line, the market was extremely bearish. The sentiment was extremely bearish. Any way you slice it, really, this does not look like a good risk-reward play right here. If you want to play it from the long side, we're hitting significant resistance. We're seeing significant divergences on the S&P and the HYG. We're seeing yields start to move back up. We're seeing the dollar start to move back up. This does not look like a good entry to me at all. Now let's take a look at Tesla. I did talk about Tesla right here when we saw this bounce back from these levels right here. This is a critical pivot level, guys. I had this level drawn up for a long time, long time, ever since we've been moving sideways right here, and it proved to be a significant level. Why? We had this massive gap right here. Once we broke through that, it acted as significant resistance. Once we broke through that, it now acted as a level of demand. We were seeing buying off this level. So to me, this looks like a potential cup and handle formation as long as we move sideways and do not move back down and retest this level again. In my opinion, that would be bullish for Tesla. But remember, guys, Tesla is a high beta stock. So if the NASDAQ starts to sell off, Tesla will have to sell off with the market. Let's take a look at AMC. Massive red candle right here. This looks to me like a typical Wyckoff distribution. A blow off top right here. A retest. We do not manage to take out the previous high. We sell off and we're now breaking down. This is a typical topping formation. Be very careful with AMC at these levels. Let's take a look at GameStop. This is daily chart for GameStop. It's absolutely insane to me that we've made this massive rally, this absolutely humongous ramp, and we've actually been moving sideways for more than a year and a half now. This goes to show that if you've been shorting GameStop, you've been losing a lot of money. Taking a closer look to what is happening, again, we had this rally, this blow off top. We did not manage to take out the previous highs. We now rallied again, attempted to take that high. We failed. We're now selling off. Again, this looks to me like a bearish development, and we're getting really close to a bearish crossover on the PPO. Let's take a look at BBBY, Triple BY, Bed Bath & Beyond. I started to talk about the stock right here at $8. In fact, I wanted to get in at $8, but we ended up gapping up the next the Monday. This was Friday. We ended up gapping up on Monday. I waited for a pullback. I got in at the pullback here at this breakout at $10.9. I played this all the way to $26.50. So I got really lucky at closing my position near the top, and I made 140% profit. I did make a separate video about Bed Bath & Beyond. If you're trading this name, if you're in this name, if you're interested in this name, please check that video out. But again, the way that we caught this was we had this beautiful double bottom formation right here with positive divergence. Once we took this 50 period daily moving average out, it was clear to me that we will rally. My price target was between 25 and 30. Because we had this double rejection right here, so it made sense to me. It was also the 50% retracement level. We retraced that level now, and we're rejecting off that level. Do not be surprised. Do not be surprised to see the Bath & Beyond go all the way back to just around $10 and trade sideways for a little while as the market sees weakness. Do not surprised to see that if it happens. But coming off that weakness, I do suspect that Bed Bath & Beyond might be able to recover. My next price target is $80 near the all-time highs. Not there, right here near the all-time highs, right there. And my ultimate price target is at $150, 30x from the bottom. I went and looked at GameStop and AMC and a bunch of other squeeze stocks like KOSS, like Newegg, a bunch of stocks, okay? And it was very obvious to me that at a minimum, all of them had rallied to 30x from the bottom, okay? Some of them rallied even higher than that, like GameStop and AMC. But most of the meme stocks rallied at least 30x from the bottom. That's why I have my price target at 150. That would also be 2x from the previous all-time high. Again, guys, if you're interested in this stock, please check my other video out in my channel, the BBBY video. I talk exactly about how I traded the stock, how I'm currently holding at zero risk, how I took my risk down to zero, and yeah, just check it out. I go through my whole trade plan in that video. Now let's take a look at oil. Oil is still showing weakness, but I am seeing a very subtle divergence here. Let's take a look at the 2-hour chart. Look at this, guys. We had a lower low right here compared to here, but a higher low on the 2-hour chart. So we're seeing a small divergence here. If the yield continues to move up, I expect that oil will start to recover. On the downside, there remains a significant risk that we will go and revisit the previous high right here at about $85. This will be a significant demand zone. I expect a lot of people to be buying oil off these levels. Now, more importantly, guys, I do want to show you Exxon Mobil. This is the largest stock in the S&P 500 energy sector. And I do want to show you this massive, absolutely humongous pennant. Okay, we have this absolutely ginormous pennant. Now watch for a break either to the upside or to the downside for a massive move in Exxon Mobil. I am seeing accumulation. I'm not seeing distribution just yet, right? I'm seeing more up volume, more green days than red days. And this suggests to me that somebody is accumulating a lot of Exxon Mobil shares. On the weekly chart, this looks like one absolutely ginormous bull flag, a bull pennant. Again, we need confirmation. Watch for a confirmation, a break above this descending resistance line. If we break above and we stay above, that would signal the beginning of a new rally in energy stocks. For that to happen, guys, we still need to see oil prices stay strong or even start to move back up. That's very important. The way you can play this, guys, is maybe you can do a strangle, or maybe you can buy a call spread right here and a put spread right here. So you might be able to do a strangle or maybe do a double spread, a bullish spread and a bearish spread. If you're into that, in my opinion, it's a lot better to bet on one side and maybe have a small hedge to the other side. So watch for a break, either to the upside or to the downside. Now let's take a look at the beat rate data. We're sitting at 60%. This is a horrendous reading, one of the worst readings that I've seen in a while. You want to see this reading at least 75 plus in the run-of-the-mill vanilla bull market. This percentage has been declining steadily for weeks now. For weeks and weeks, I've been watching this percentage and I've been seeing it decline steadily. Even though earnings expectations have come down significantly, companies are still failing to beat those revised earnings expectations. So watch out. It appears to me that we're seeing a small recession in earnings. Let's take a look at fear and greed. We're sitting at 55. We went down from 56 a couple of days ago. Let's take a look at the timeline. Look at this, guys. I did talk in the previous video about how we need to top around 58 on the greed reading for this to indicate that we're still in a bear market and that this is probably a bear market rally, right? Because we've been trending down. We had this reading at 77, 66, and the last reading in the last bull market, in the last bear market rally was 62. And we're now rejecting off 57. We could still see one last greed reading that pushes into 58, 59, but we need to see a reversal down from there. Market momentum, we had this clean break of the 125 daily moving average. The previous times that we've seen a break above the 125 daily moving average in February and late March, in the previous bear market rallies, we had a brief spike up and a rejection, another brief spike and a rejection, another couple of spikes right here and a rejection. Now, guys, again, watch for a pullback to the 125 daily moving average. And if we start to see the market actually bounce back up and continue to move up and make a higher high after bouncing off the 125 daily moving average, that would be a massive signal for the bulls that this is very likely the start of a new bull market recovery and not just a bear market rally. If we see a pullback to the 125 daily moving average and then we see a bounce back up, but we fail to make a new high, maybe we'll make a double top, a lower high, something like that, and start to sell off again, that will be a warning sign and a signal to go back into being bearish. Let's take a look at the stock price strength. We're sitting at extreme greed readings. We've just hit the 0% line. I expect to see this line rejected and for us to start moving back down. Stock price breadth. Breadth has actually been basing for a couple of months now, but we've just seen a significant break to the downside, a new low in the price breadth. We're now seeing a new low on the McClellan Volume Summation Index. This is a key indicator, in my opinion, the most important indicator for trying to figure out if this is a bull market, a new bull market, or just another bear market rally. For us to get out of this bear market, we need to see a lot more stocks participate in this rally consistently and for a long period of time. We need to see this base and start to form perhaps a U-shaped recovery. We need to see that for the bull case to be more valid. Let's take a look at the put to call ratio. We're sitting at a very low reading. This makes buying puts very cheap. So please take advantage of that if you want to hedge your position, or if you want to go full bear, you can do that. It's very cheap. We tend to see bounces in the put to call ratio when the market starts to sell off. So this might be the last opportunity to get into cheap puts if you want to hedge, or if you want to go bearish. Market volatility, again, I talked about this. We've been basing for the entirety of the week so far, and we're now seeing a brief spike. Watch out if we see a bullish crossover. That will be the end of it. That will trigger the strongest sell signal in all of the indicators. So keep an eye out. Safe haven demand. Again, people are dumping junk bonds in favor of the investment grade bonds. So again, another signal that this rally is probably topping. Junk bond demand. The yield spread is now widening again. People are dumping junk bonds. Now, it's very important to point out seasonality. We're approaching that massive sell-off season at the end of August, early September. We always tend to see a massive sell-off, and let's say the last 10 days of August. So watch out, guys. In midterm years, we tend to see very significant weakness in September and a massive spike in volatility in September and in October. So watch out. We're now seeing significant divergences on the daily chart. We have the Jackson Hole Symposium at the end of next week, and we have, look at this, guys, next week we have the dreaded PCE index coming up on the 26th, on Friday. This is the preferred inflation measure that the Fed goes by. If we see a spike again in inflation, this will absolutely put an end to the thesis that inflation has peaked, and it will lead to an insane stock market sell-off. So watch out. This is a very risky time to trade stocks, especially after this massive rally that we've seen so far. Now, this week, guys, today we have the initial jobless claims coming out. We also have the Philadelphia Fed Manufacturing Index. Watch for a surprise to the downside on both of these to signal a weakening economy. We also have a bunch of Fed officials speaking, and on Friday we don't really have much going on Friday, so we might just see some sideways momentum, some chop, and then next week we might see that sell-off. We have the S&P Manufacturing PMI coming out next week, core capital equipment orders, more jobless claims figures coming out, the revised GDP figure. If this gets revised down below the previous estimate, watch out. And then we have the inflation reading. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye. Oh, wow.